When determining your strategy, there are a few different things that you want to consider when getting started. First off, you really want to try and understand your goal. Obviously, everybody wants to make money, but is there a specific goal that you have in mind with investing? Like, are there certain types of stocks that you want to invest in? Are there certain ways that you want to manage your portfolio? Or do you have a certain threshold that you want to maintain with how frequently you're interacting with it? Some other factors to consider are like what type of risk level you have and how much risk do you want to take on. Leveraging different metrics will allow you to do that, but is there a certain metric that you'd prefer to use? And then different metrics support different strategies, but think about if the ones that you want to use actually align with your goals. And as we cover these concepts and walk you through this lesson, those are some of the questions that we hope to help you answer. Just as a reminder, the metrics that we have available in our system and test are expected return, alpha, Sharpe's measure, trainer's measure, and the overall average. At this point, we've been able to come up with some level of understanding of when using these metrics works, but it was really, when we began to expand into other questions like what is the best historical time period to use for calculating these metrics, how many stocks should you include in your portfolio, what optimization frequency works best, and what sort of economic conditions produce the best results for each. So we investigated those questions and then we graphed our results. So let's take a look at the results of our testing and go through each metric. Starting with expected return. In the upper left corner, we have the first question that we tested: how many stocks should you include in your portfolio? You can see for expected return that actually having fewer stocks in your portfolio performs the best, although it doesn't really look like there's a bad option here since all of the portfolios perform well. If you think about the stock selection with expected return, it's just based on stock price performance and who's been performing well. And if you only have a few of them in your portfolio, you're less diversified, but taking on that added risk allows for those higher returns. So that's really what you're seeing here, that all of the portfolios performed well, but if you're someone that only wants to invest in only a few stocks, this might be a good strategy for you. In terms of the optimization rate and how frequently you should be rebalancing your portfolio using this strategy, you can see that bi-monthly or semi-annual are the returns that jump out here. So that means that about every 2 months, or at a minimum every 6 months, you're checking an optimizer to see if your portfolio should be rebalanced. Now, our testing does show that you can rebalance about every 2 weeks or so, but I would stay away from a week or less, or from balancing your portfolio only once a year. Those options tested below the market, and again, optimizing every 2 months perform the best. Then in terms of the historical time period that you can use, which again is just referring to the range of data that you're using to calculate your estimated return, you can see that it continues to go up as the total amount of historical data increases. So when you get to about 10 to 15 years, you can see that those are really some of the best performing portfolios. And if you think about that, that just means that over a 10 or a 15-year period, the stock that receives the best grades had really well-performing expected returns for a long period of time. And that will help you find companies that have produced stable growth over that time period. The last chart we have here shows the annual performance for our expected return portfolios over the entire testing time period. You can see the market performance by year with the black bar, and then the gold bar is the performance for the expected return portfolios. You can see that some of the years had some fairly extreme returns, and in 2018, 2019, and 2020, some of the selections that were made performed really well, but I would consider those more as anomalies than something that I would expect to repeat. Many of the other years are much more in line with what you'd expect to see here. Anyway, I just thought this was an interesting chart, and I wanted to include it so that you can see the performance over time to help you understand which metrics work best for different economic conditions. Our plan here are to update these studies more frequently and to post the results on our sites so you can see what's working. In terms of alpha, as far as how many stocks you should include, you can see that you should have at least 12 in your portfolio, and actually 30 tested the best, but keep in mind that 30 can have a large workload that comes with it. In terms of the optimization rate, It's a little more short term. Biweekly and monthly tested the best. So about every 2 to 4 weeks, you want to optimize and rebalance, which makes sense, when you look at historical time periods that you should leverage. The testing indicated that a shorter set of returns like 90 days or 1 year perform the best. And if you think about it, that makes sense. Alpha is a metric where it's identifying a return that's not produced by the market. So if you're trying to use alpha as your strategy for identifying good investments, you're going to want to look more at investments that are doing well in the short term. So by identifying assets that are doing well over the last 90 days or the last year, that appears to give you the best chance for capturing returns when using alpha. Then you can see the historical performance over time here as well. For the most part, alpha performed well in years of economic expansion and growth. You have to be careful though, in years where the market performance is down, a lot of investors will move to more stable long-term investments, and short-term investments can end up seeing losses. When it comes to Sharpe's measure, this tends to be what investors on Wall Street like to leverage when they're constructing their portfolios. Now, not necessarily all of them, but a lot of the ones that are really into the math and the statistical side of investing, they tend to appreciate Sharpe's measure as a metric for understanding who's really creating value out there. I also think that it tends to be a metric that a lot of academics tend to use for portfolio construction, and the results here reflect really what I was taught in class, which is that your portfolio should include about 8 to 12 stocks, and you should optimize it about every 2 to 4 weeks. In terms of the historical time period, this shows that anywhere from a 5 to a 10-year range works well, with 8 being the best. And you can see that in general, Sharpe's measure tends to mirror the market returns. Now, there are certainly years where there's a little more or a little less than the market, but for the most part, Sharpe's measure just helps you identify stocks that have been stable over a long time and are consistently producing a premium for the risk that their investors are taking on. Now, it's true that you can earn higher rates of return with other metrics, but Sharpe's measure-based portfolios tend to be more stable, and they act more like index funds. Then we have Trainer's measure. This metric represents the premium that you get for every movement in the market. So stocks that do well during volatile times are typically the ones that are identified here. These stocks can occasionally produce some extraordinary returns, but they also tend to be a little bit riskier, and you need to pay more attention to their beta. In terms of how many stocks you should have in your portfolio, with Trainer's measure, you only want to use a few of them, like 5, or a lot of them, like 30. And that's because you're trying to leverage that variability and capture that return. And by only having a few of them, you can do that, but also by having closer to 30 of them, really what you're doing at that point is you're building more of an index fund and you're capturing your return that way. So when it comes to the return time period, really 90 days and 10 years perform the best, which really the short-term view, in my opinion, is a little bit safer. Now, that's not to discount the fact that if you have a stock that's performed well over 10 years, certainly that could be a great selection as well. And then in terms of how frequently you want to optimize your portfolio, our tests indicate that you want to be more in that 4 to 8 week range. And you can also see here the historical performance and the returns using this method over the time period. You can see that many of them are quite high. And that has a lot to do with the risk associated with these stocks. So if you do go down this route, it is a little bit riskier. And like I said a moment ago, I would just pay attention to the beta of the stocks that you're considering. Just do that to make sure that you're not taking on any unnecessary amounts of risk. And if you end up building a portfolio, with a beta of 4, you need to understand that your portfolio can swing dramatically from day to day, and that's not something that most people can stomach. So when you take a snapshot in time, like these results here, what the charts don't show you is how much the portfolios were going up and down on any given day. It just shows you the final performance. So don't get overly excited and take on a whole bunch of unnecessary risk. Do the best that you can to mitigate the risk before jumping into the portfolio. Taking a closer look at the average, in my opinion, this is one of the best ways to find out if a stock has good metrics or not, Since, this is the average of the other 4 metric rankings, the stocks ranked high here had a high-performing expected return, alpha, Sharpe's measure, and trainer's measure. So when you're looking at stocks using this metric, you're going to generally find stocks that are a little bit more stable. In terms of what our testing found, you can see that with the historical time period, the returns go up when there's more time added. 8 years had the best return. When it comes to optimization and rebalancing your portfolio, doing it monthly resulted in the best return. And if you think about it, looking at your portfolio about 12 times a year really doesn't take that much work. Something else that I want to mention is that you can include a lot of stocks with this strategy. The recommendation shows anywhere from 12 to up to 30 can work out well. So this strategy is one that if you have a lot of stocks that you're interested in investing in, or if you like to collect them over time, this grade can be a good point of reference. Also, I like to reference the average when you're already using another strategy, just to see if the stock had performed well across the board. Coming back to our strategy recap, hopefully these results make a little bit more sense now. Depending on how you're looking to invest, there are a variety of different strategies that you can deploy. And when I first started down this path of testing all of these things, I didn't think I was going to find results like I did. I thought there might be some slight differences, but this just goes to show you that your strategy really can make all the difference, and that these metrics can be very useful to you, but in certain ways and when viewed under the right circumstances. So honestly, I was surprised when I saw all of this, and it's the reason that I started working on this training program. And for the future, our plan is to continue to update our studies and to provide those results to our members. We want you to not only be educated on what works, but to have the best available data and reporting to help you with your research. And really, these are the strategies that we support. The next section in this training, we get into day trading, and especially if you're new to this, that's not really a path that we're recommending. Before we move into that, let's just revisit this concept once again. Hopefully this method makes sense to you now, and you're beginning to think about how you want to manage your portfolio. As we walk you through the remaining lessons, start to think about what you want to invest in and why. We'd recommend keeping a notebook so that you can keep track of your ideas and record any feedback that you want to reference later on.